key breadth and volatility index levels defined. And if you're thinking of buying a major energy ETF, you don't want to miss what I quantify in today's REKTelligence report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave Bush. This is the All Markets Report where I quantify across asset classes with an eye to the week ahead. And again, I'm going to have an equities focus, a dash of commodities to be sure. Let's get into it. I'll start with the stock market, and again, like last week, with breadth, specifically stocks above their 20-day moving averages inside the S&P 500. Last week, we saw this was around 35% by the end of the week. By the end of Friday, this had dropped to less than 22%. So we continue to see breadth deteriorate, but not to any type of extreme. Crucial to my analysis is this REKTelligence score, which is an objective function. That's a fancy way of saying a single score that takes into account many metrics and dimensions, such as profitability, hit rate or win rate, edge quality, return efficiency, and risk in the form of drawdown. The way to read it is it's 0 to 100, 100 being the best. Insufficient data, these are strategies with less than 20 trades. These do not even get a score. Frontier or emerging, these are strategies with greater than or equal to 20 trades. These show a score, but are not always statistically significant. And validated, these are strategies with greater than or equal to 30 trades and an asterisk or star indicating they passed a t-test at a p-value of less than 0.05. That means less than 5% chance that the results are due to random noise. In other words, they're strong signal. These, of course, are statistically significant. In 30 seconds, we'll get into the stats. Traders, crypto is not a wild, unruly market. It's an asset class with 500% more time for price discovery and opportunity. My new course, Crypto Trader's Edge, is now live through Algo Advantage, one of the top quant pods and academies out there. A full systematic framework, backtesting, strategy development, validation, real edges with full code, not hype. Links in the description or head to my Substack at REKTelligence. Now back to the show. All right, we've got an equity curve here for current conditions. Those are the breadth conditions we already defined. Data is 2007 to the present. That's what TradingView offers for this metric. And you can see for the SPX, the S&P 500, there are 75 instances and the average trade is just south of 1.5%, 1.49%. Now, the REKTelligence score, this is less than 50. What's a great REKTelligence score? Well, perfect is 100. But the ones I love to trade are 70s, 80s, the occasional 90-something. Those are often amazing opportunities. Obviously, this is not close to that. We do see that the statistics here are significant. That is a good thing. So this is a pretty reliable, at least in modern history, 07 to the present, 1.5% on average with a 1-month exit. Let's look at a more extreme scenario. What if breadth continues to deteriorate in this war situation with rising energy prices and all the uncertainty? Let's say this drops to 15%. Here's the equity curve. Same data set, and we see 60 instances. Average trade now for the SPX is 1.92% inside 1 month, meaning a 1-month exit to be more precise. REKTelligence score, 48.6. Again, it's below 50, but stats are significant. Profit factor now 70%. Hit rate improved a little bit from 2 out of 3 on the last slide. Profit factor here, 2.169, so north of 2. Very nice. Let's look at a more extreme situation yet again. So 10% now for this metric. 38 instances in the data set. Average trade for the SPX with a 1-month exit, 2.17% now. REKTelligence score jumps above 50, good to see. And hit rate and profit factor are a little bit better. They're roughly the same. Equity curve, arguably a little bit smoother. And let's now turn our attention to the QQQ. Let's see with current conditions, does it fare any better? So here we are, current conditions, 22%. We're slightly under that, as you remember. And if we traded the QQQ in this scenario, we can see that the average trade here is 1.97% right off the bat without any further deterioration in breadth. So this certainly offers arguably a better opportunity. REKTelligence score here, again, not fantastic, but 47.9, and the stats are significant. Last week, I looked at the VIX or Volatility Index with some stats for some historical perspective, but I did not look at it in a trade scenario. I'll do that today, but let's just see where the VIX closed on Friday, and you can see 27.18. It's not at an extreme, at a higher level. It's certainly not at a low level. So we're in between in this kind of purgatory, but definitely elevated. Let's see how this is done historically or how the stock market has done. Before we do that, though, another perspective. You can see I've got my REKTelligence stretch percent indicator here. That is what you see on the bottom, the orange and magenta. And those boxes in white indicate some extremes where the volatility index has gotten pretty stretched above its 20-day moving average and has quickly reverted. These are often associated with market lows. So the spike in the stretch index or percent index and the quick reversion of volatility down and often stocks back up. So we're not really seeing that right now. We saw this happen last week, this spike and then this reversion back down. But you can see we are here, we're elevated, but we're not stretched currently to one of these extremes that we've seen of late. All right, we've got an equity curve here for this very simple condition by the SPY if the volatility index closes greater than or equal to 27, basically current conditions. Exit in 1 month's time, data from 1990 to the present, history of the VIX itself. Average trade here, 1.6% inside a month. Definitely a positive edge. It's statistically significant. That is good. REKTelligence score is sub 50. That's not great, but 42. And we see that drawdown very steep back to the great financial crisis. Once again, spring of 2009, 47 and change percent drawdown. Ouch. Let's look at the same condition buying the Qs instead. We've got it right here. And we see average trade 1 month later, 2.35%, REKTelligence score 46.1, a little bit better than we just saw. Again, significant. Hit rate here 69% of the time. It's profitable. Profit factor a perfect 2.0. Now, just like we looked at breadth being potentially more extreme soon, let's look at the VIX potentially being a little bit higher soon. So we'll go back to the SPY, and by the SPY, if the VIX closes greater than or equal to 35, exit in 1 month, hypothetical equity curve here. Average trade now has jumped up. This is definitely a more extreme VIX level, 2.49% a month later for the SPY, 1990 to the present. REKTelligence score 49.6. Not great, but not horrible. Not significant, which is interesting. We have fewer instances here, but the hit rate is 75%, profit factor 2. Let's go to the Qs now in this more extreme scenario, with the VIX closing above 35, and we see Qs show a 4.19% 1 month gain in this scenario. We see a REKTelligence score now 62.7. This is respectable. It is statistically significant, although we only have 29 trades instead of 30, so it doesn't get the star. And hit rate here 68.9% of the time. It's profitable 1 month later under this scenario. Profit factor 3.1, excellent, and a really pretty sweet looking equity curve. So this now gets me a little bit excited. And of course, it would require VIX being a little bit more extreme. Going to turn to commodities again. And yes, you guessed it, to crude, and ask this question. With crude having closed at a 1-year high, what does this mean for some major energy ETFs? Let's find out. So first one I looked at is XLE. This is the State Street Energy Select Sector Spider ETF. And the condition is simple. Buy if crude closes at a 1-year high. Data from 1998, the end of that year, to the present, 53 instances, and I've got a 1 month hold here. Average trade is negative. Equity curve looks pretty horrible, not statistically significant. And we see overall this has been losing. We can go through the stats, but no edge here clearly. Let's go and look at the same condition with OIH. This is the Van Eck Oil Services ETF. Data February 2001 to the present, 49 instances, pretty clear downtrend. Profit factor 0.5, well below 1, which is so-called break even for that. Average trade is pretty seriously negative, negative 1.26%. So clearly no edge here. Let's look at one more. We've got XOP, the State Street Spider SP Oil and Gas Exploration and Production ETF. Data June 06 to the present, 35 instances. and it looks like some kind of EKG. Average trade is slightly positive. That can only be due to path dependency because total P&L is negative. Basically, no edge here as well. So the idea that crude rising to a one-year high would help these energy ETFs is clearly not the case for the data that we have. All right, everyone, if I could sum up today's All Markets report, it would be this. I'd love to see things a little bit more extreme. More deterioration in the breadth metric we talked about today could set up a nice trade, especially in the Qs. Greater volatility closing above 35 could do the same. And folks, thanks for watching today's All Markets report. I will be back as usual every Thursday with the Edge report. I'll see you then. Until then, trade smart, be well, and cheers from the Caribbean.